Welcome to another episode of ETF 360. I'm Tom Lydon with ETF Trends, along with our Director of Research, Dave Nadig, and we have a special guest, Darren Schuringa, who's founder and CEO of ASYMmetric ETFs. So advisors that are concentrating on risk management during these times, what do you do? How do you help them?
ASYMmetric ETFs recently launched its first ETF that trades under the ticker symbol ASPY, ASPY. ASPY is designed to provide protection against bear market corrections, as well as capturing the upside of bull markets. So it's a great way for investors who are looking to stay invested in the market while at the same time knowing they have some built-in protection.
So you talk about ASPY being sort of this disruptive tool that sort of moves from a risk-on position to a risk-off position based on sort of how the market's doing. So what are the nuances there? What are your signals that make you take more risk or take less risk?
Sure. Asymmetric is driven by asymmetric risk management technology. The technology is behind one of the largest hedge fund seeds of 2015. And ultimately, what it's doing is driven by proprietary price-based algorithms. And the algorithms, they look at price movements of the market. And if you think of it, Dave, common sense is, how do we make markets how do we make money as investors? We invest in the market. So what are we focused on? We're focused on what the market is doing. And that's telling us how we should be positioning the portfolio.
So Darren, I know we have a lot of advisors that are trend followers. And in order to be risk off, you kind of have to see a dip and below major trend lines. Are you saying you actually, within your technology, look for greater or higher valuations in order to trigger taking some risk off where we might be at new all-time highs, but things are really rich?
Actually, that's a great question. No, back to my earlier point, we're looking at price movements of the market. Because remember, markets are driven by individuals. So what drives individuals? Fear and greed. So we're not trying to make fundamental calls, because what I've learned in my life is you can be fundamentally right and absolutely wrong. Again, going back to the principle, we make money in the market. So what we're looking at is if the market wants to run higher, the speculative frenzy is high and juices are flowing, we're going to follow the markets up. Again, a trend following strategy. And what we're looking for is when the markets break these trends. So we want to participate in the full bull market run, as well as being protected in a full bear market or down market.
So it sounds like you're taking some of those things that we associate with really successful active managers, being willing to make those tough calls, and you put a system around it.
Correct. We're removing the human element. We're systematically managing net exposures in the portfolio because, again, we can be our own worst enemy. We think something's going to happen. We come up with a thesis that the market is going to continue to trend higher because the Fed remains stimulative in today's environment. Well, that may or may not happen. So if we stick to our thesis, but the market says something different, what's right? The market's right. We're not right. So our technologies bake that into it. And really, it's a common sense approach to investing that don't fight. You've heard it. Don't fight the Fed. In this case, don't fight the tape. Do and listen to the tape and position the portfolio to profit from either a bull market or to profit from a bear market. That's what ASPY does.
Darren, we know that traditionally individual investors, they're just not great at timing the market. They're usually too late when they realize that they need to pull out the parachute or the life jacket. Can you address that and how your systematic approach steps in before most people realize that things are starting to fall apart?
Absolutely. The emotion, again, of fear and greed. You're coming in by the time the market is already run and it's so high, but now you can't afford to miss it any longer, and you're getting out at the bottom when the pain is so great. What our system does is we're looking to identify long-term trends with one of our indicators, our price momentum indicator. And then on the second one, the spike in volatility, our price volatility indicator is saying when market volatility spikes. So when these two come together, we're in a risk-off environment. And I think the best example of that, if you look at the crisis last year of COVID-19, when the market pulled off 24% at the low in March, in 1 month, we had a signal a month before the market had broken down technically. We went into a risk elevated position, and that's telling us, well, there's a lot of uncertainty here in the market currently. And what did that mean? We were market neutral. So when the market dropped 24%, investors in ASPY found themselves to be flat for the month. They're actually up 10 basis points. So that's a real live example of where most people thought the markets were fine coming into March of last year, and COVID wouldn't last that long. Our signals are sensitive enough that they got us into a risk elevated environment, meant we're market neutral and protected investors' capital from the worst of COVID-19.
So it sounds like a little bit of a no more FOMO strategy.
Correct. That's exactly what it's designed to do, Dave. It's designed to be the slow and steady equity exposure in the portfolio. It's designed to produce absolutely positive returns in absolutely all types of markets. And so for investors today, it's a new tool that they haven't had access to prior to ASPY coming to the market and bringing it and introducing our new technology and our new solution. So it's something that investors and advisors should be looking out for, because it's a way to stay invested without the fear of getting your face ripped off in the next bear market.
Yeah, nobody wants that, Darren. Belt, suspenders, parachutes, life jackets, adult diapers. We want them all. Thanks so much for being with us, and hope you come back to ETF 360 again.